Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, September 16th, 2019. In this video, we'll cover the broad markets. We'll take a look at the NASDAQ 100 and S&P 500 futures. Time permitting, I'll get to the small caps as well. Also look at QQQ and SPY. And then I wanted to roll over real quick, go over the 11 sectors in the S&P 500. There's some notable developments to mention there. And that should be it. And I may do a follow-up video. Members, earlier today I've talked on oil, did some analysis on oil, gave you my thoughts there with the big move in crude oil today. Also gold, silver, precious metals, and treasury bonds. If anything, that'll come out in a separate video. We'll just stick to the general market analysis here on the equity markets. All right, so the big thing today is, or really was last night, we had a gap down. Remember last week we were watching these wedges right here. We had 60-minute large rising wedge, or a larger rising wedge, I should say, right here. This being the most important trend line. And then within there, we had a smaller wedge, and that smaller wedge broke down on Friday, took us down right to that key 78.83 support, parked there, traded there pretty much almost most of the session on Friday, and then we gapped down. When the futures opened Sunday night, we gapped down right below their perfect gap below the trend line. And let's get to that. I posted I did an update last night, and let me see if I can pull that up for you here. This would be it. About 10:30 last night, 10:20 or so, I posted this on the right side of the chart that the futures had broken down. So I came out on Sunday night with a post showing you, here, let me zoom in on that chart, saying we broke down and that both NQ and SPY were at support levels, or I'm sorry, ES and NQ were both at support levels where I expected a bounce. I showed you the bounce coming up here. Here, we'll zoom in a little bit so you can see ES at gap below was trading at support, with NQ at a more significant support. I'll get to that in a second. And so I had us bouncing up here, coming in to maybe come into these gaps, a backfill. That's where that horizontal line, it's the top. You can see there's a gap from where we closed Friday, or Friday's low, I should say. And it comes in about with a back test of the trend line as well. So I was able to, been hopefully somewhere last night, able to close short positions, reverse that to a long for a bounce trade today, and that worked out well. And so from here, I think the upside limited, there's maybe a little bit more upside I can see in the overnight futures, maybe into tomorrow. But you have, again, the pretty significant gap resistance in the downtrend line above. So that was last night's scenario, or chart, and this is NQ last night, and there it was. So that was pretty much a no-brainer, because this level right here on NQ 775, 77.75. And by the way, these are the September futures rolled today to the December futures. I'll get to that. So the levels are going to be a little bit different. I'll show you that chart. But again, the reason that level was so significant and I expected a bounce, there were just numerous reactions. Remember, it defined the top. Did an excellent job of capping all advances on the August trading range, every single push to that level. Then we broke out. It was impulsive. That was another reaction, an impulsive breakout, I should say, not a reaction, but the fact it was impulsive. Back tested it perfectly, tested it again there, and so the probability was very high for a bounce. And I also said this last week, we have the Fed on Wednesday. I don't think this market's going to go very far until the Fed's out of the way, so it's a great trading, great time to, when you see a pretty near-term oversold bounce, or I'm sorry, near-term oversold drop to support, good chance to go ahead and cover shorts and go long for a bounce there. And the same story, when we bounce up here. So again, that was last night's. That's what I posted those last night, and there was RTY as well. Here, I'll go to RTY for you. Same thing. RTY was at no, that's NQ. Here's RTY. RTY was just above that 1565 support, so I had us going up and rallying in RTY. It went a little bit more than that bounce target there. And then let's move on to today. Let's see here. Did Semiconductor Analysis earlier. This one I want to cover right here. Stock futures were approaching those bounce targets, so this is what we were looking at here. This was last week where I had us going down to that 775 level. Figured we'd get a reaction there, but we gapped right on past there, so there was no reaction off the bottom of the wedge or that uptrend line, because again we closed just above it and then gapped down. Remember, this is last week's chart, had us going down here to that 775 or 77.75 level. That was the one I just showed you from posted last night, having us bounce up here, and then I have us kind of going like this for the rest until the Fed's out of the way. You can see here, I'll expect as I said, expect a reaction off there, 78.83 or so on again the September futures, and then we'll probably grind around. But I do expect that big 77.75 level to eventually give way here, and I think it'll come after the Fed is out of the way, because I'm still looking for, here I'll show you here, back test. So this was earlier today. Again, I showed a possible drift up here to about the 78.83 level. Really, pretty much, if you look closely, reversing anywhere from the top or bottom of this gap. And I'm talking, again, the gap that happened last night and Sunday when the futures opened between Friday's close and then the open Sunday evening. And so that's, again, earlier today, and have us coming back down here. So that was earlier today. Let's take a look at the futures. Here's the same chart we're looking at. I'm going to zoom in a little bit for you and get a little tighter here on this, on the NQ. So there it is. So there's that gap I was talking about right here. We filled about half of it, backfilled it, reversed a little shy. Here's a minor trend line that I added since then, and we broke that earlier today and we were back testing it. So really, look, that's close enough so far. And where we go tonight, between tonight and tomorrow, anyone's guess. Probably just as well see us drift up here, make a full back test of the either a full backfill of the gap or a back test of the trend line, and then come on down. But again, don't expect, or at least anything is possible, but I don't expect any big moves in this market, up or down, until the Fed's out of the way. And I think I've been pretty clear on which way I think it breaks from here. Okay, those were the September futures, and they've rolled this week. So now you want to look at the December futures on NQ. Here's the same trend line that we broke and gap down below, and you can see the numbers or the values are a little bit different there. So we have, there's that 78.82 level. It still comes into play here, but it's at the bottom of the gap, because you're going to have different values on the September and December futures. But there's the gap right there. And when I look at the December futures, which we're looking at here, we made a virtually perfect back test of the trend line today. So these are now the continuous contract. And so when I look at these December contracts, you can say we pretty much backfilled that, or back tested the trend line there. Top of that gap is about 79.06, 40 or 50, we'll call it, on the December futures on NQ. And then what we need to do here also is add on the December futures, redefine the top of the trading range here. And I'm referring to the August trading range right there. It comes in around 77.90. So that's now, from going forward, I'll start to use this the December futures here. And ES, my broker hasn't rolled the continuous contract yet to the December, so I'm still working off the Septembers here. And again, nothing's changed. I still think we come down at least at minimum for a back test of the August trading range. Very, very well defined in ES as well. And remember, NQ already back tested it couple times, including today, whereas ES has yet to backtest that level. So at minimum, I expect to move down there. And this is why, if ES does this, NQ, which remember just bounced today off there, rallied off there, will almost certainly move down below the top of it, or back into the August trading range. Again, if ES comes and backtests the top of the range, because ES is still so much above it. It's held up a lot better than NQ. And again, I've talked on that. That is the market-leading stocks, the former market-leading stocks, Apple, Facebook, Amazon, Microsoft. They are lagging behind on this since the breakout here. They have already come in and back-tested, whereas the S&P 500 has held up relatively well compared to the tech-heavy NASDAQ 100. So that's it. And you zoom in a little tighter, and you can see, just like I showed you on NQ, we have a minor downtrend line. It's just active trader stuff. There was a minor downtrend line we broke down, back tested today, and you can see, just like NQ, we backfilled about half of the gap. There's a big gap down. And so again, the Decembers are going to have a different value, but on these September contracts, they're about 3,006 or so is the top of that gap there. And there's a little room too to push overnight or tomorrow or anytime before the Fed on Wednesday and still come up and make a back test of the trend line, the uptrend line on ES, because we did not do that today. And like I said, depending on which contract on NQ you look at, we either did or didn't do. Here's SPY. Same story. We have a comparable uptrend line on SPY, and that was taken out today, so that gave us a sell signal there. But again, not a sell signal you want to jump on, or at least not aggressively, with the Fed on deck for Wednesday afternoon at 2 p.m. So you have a minor downtrend line here off the highs. You can watch, break of that, could bring us up here, make another run at the highs. Remember, we had a brief marginal new high on SPY, and it failed. We moved back down. So we're below the trend line. That's the bottom line. Let's move away from the index ETFs. So we have those breakdowns, and technically they are sell signals, and we'll need to respect that, because that's a bearish technical event. But again, we'll probably remember last time around too, we had the same story. We had the breakdowns right before the Fed, but it was only until after the Fed was out of the way. This was the July Fed meeting right here towards the end of July. And so although we had sell signals, divergent high, it took until the Fed was out of the way for the selling to kick in. And again, because the market's going to go on hold waiting to hear what they have to say. And there's QQQ. There's that same trend line. That's the one we were watching last week. And of course, with the gap down in the futures, when the markets open today, QQQ gap down as well and remain below there. And kind of a little bit of a flagging type action, but I wouldn't read too much into that again. If we do come down here, you can see that QQQ did not test the top of the trading range today, although NQ did. And again, I'm referring to the August trading range there. So a little more downside to come at the very least. Sometime probably by the end of the week, and we'll just go from there. Okay, daily chart of QQQ. Remember, SPY broke down has been back testing the trend line off the lows in the December 24th lows. QQQ is yet to do so, but that's not what I wanted to focus on. What we wanted to go through today is quickly the 11 sectors of the S&P 500. I'm going to go through these in order of the returns today. So this was our strongest sector by far. This had to do with the big rally in oil, which was up over almost 15% at one point. Came off that a little bit towards the end of the day, but still a big day in crude oil. And so what that did, obviously, unless you missed the news, that was due to the drone attacks on the largest refinery or oil processing plant in Saudi Arabia. So that knocked off. It's going to take off about, what did they say, 5% of the world's production in oil offline for the near term. And so the market's trying to process how long is it going to take for not only that refinery or that processing plant to get back online, and also how where does the other oil going to come from? There's a lot of oil sloshing around the world right now. It's just a matter of the market trying to figure out where it's going to get there. So what I had said, I had a couple questions on this. Take today's big move. It was probably the biggest move, certainly I can recall in recent years, single day move in crude oil. USO up really, really big. Again, you can see it gave back some of the gains. Certainly broke out technically, but again, it's a more of a one-off event. We'll see where we go from there. I don't want to spend too much time talking oil. Again, I shared my thoughts on the site, but I did want to go over these sectors here. So obviously the big move in oil today carried into the energy stocks. Now keep in mind, the energy sector, and this is XLE, it's a 4.5% weighting in the S&P 500. So as much as it was up today, it really isn't going to move the needle. That's a huge gain for a sector in the S&P 500, a 3.4% single day gain. But it failed to do anything more than still it couldn't even lift the index to green, and that's because almost everything else was down today. So one day doesn't make a trend, but I just want to say under the hood in the markets today, Most everything else was down. In fact, we're going through these in order again, how they were up. XLRE, that's the real estate ETF. Now, this is a defensive sector, and that was the only one that posted a decent gain besides the energy stocks, and it's not going to move the needle either because it's only a 3% weighting in the S&P 500. And more importantly, it recently broke down from this wedge here. Pretty clean trend line. We had a big divergent high right there, divergence at the high, and so it was a breakdown was telegraphed, and I talked about this on the site a couple weeks ago that the REITs as well as the utilities look like shorting ops, and so far, and that was here and before they broke down, and they have been. Now, it came up, my first target for supports here about 38.40, so we're due for a bounce. Nothing goes straight down, and but I do see more downside to come in this sector. Again, it's not going to really do the move the needle. I updated these today. I can't remember. I think it was this one here is the updated weighting. I must not have deleted the old one off there. So it's called 3% either way. Next one up is utilities. Utility stocks, again, they broke down. Not going to move the needle either. Now, here's the thing. This is flat. We're not going to call that up. It's 0.08%. Yes, slightly positive, but that's a flat day. Either way, it was, even if you want to say, okay, well, 3 of the sectors were up, technically speaking, this one was. This is also, just like the REITs, the REITs and the utilities are the 2 biggest defensive sectors in there. Staples, somewhat of a defensive sector as well, but again, breakdown, back test, and really a flat day. Now let's go through some of those that have a bigger impact on the market. Industrials, this is almost a 10% weighting in the S&P 500. It has broken above this downtrend line marginally, but it has this very steep, what I call a dangerously steep uptrend line. What do I mean by that? Well, typically the steeper a trend line is, like here's a pretty steep uptrend line, the harder the drop. And so, I know there's those out there that say, the trend is up, the trend is up. Well, the trend is up until it's not. When you're walking up a well-defined trend line like this, that's, a lot of things are pointing to a correction. That correction comes so fast that, when do you, if you're chasing the trend or following the trend, when do you pull out? If you get out here, you've wiped out just a few days, you wiped out months and months of gains. Same thing here. In just a few days, you wiped out months of gains. And that's what happens. That's the nature of the industrials. You can see these uptrend lines. Steep uptrend line, sharp drop. A little less steep uptrend line, but still a big drop. And again, that's what I'm looking at right now. So that's just one of many. That's about a little less than a 10% weighting. Healthcare, kind of cross currents here. You had this triangle type pattern. It's been sloppy trading. I don't have a very strong opinion on that. You can see some of the levels it's bouncing against. It's a little bit heavier at about almost a 14% weighting. But as I always say, this is the market. Tech is the market. When tech breaks, the market breaks 22%. There's not even a close distant second, or a close second, I should say. The distant second would be I think a 13% weighting in, let me tell you real quick, healthcare, which we just looked at. So you have a almost 22% weighting in technology. The next heaviest weighted sector is almost half that at healthcare, and then financials are both around 13%. And so therefore, this is a market. You want to know where the market goes? Watch this. And you want to know when this one breaks? It's when these trend line breaks here, especially that uptrend line off the lows on December 24th. That's what I've been talking about for a while. As I said, as with the stock market, at best, I see a marginal new high. Maybe I'll be proven wrong, but as of now, I see the upside is being limited to maybe a couple percentage points before this pattern, because if we do that, you're going to have another divergent high right here, just like this divergent high, just like this divergent high, just like this divergent high, and just like this divergent high, and this one. Those are all the divergent highs over the last 2 years. So why this one should be any different, we'll see. But that's my views. And when that breaks, that's a pretty large wedge. We're going lower, and it's going to take the market with it when that happens. All right, next up would be XLF Financials, about a 13% weighting, as I just said. And so here's why I want to do this video, is I visualize these as I look at these charts. Again, it kind of meshes with the broad market. I can see a little upside. And you know what that would mesh very well with is a euphoric FOMC pop on Wednesday. When the Fed comes out, let's just say they come out and they're a little more dovish than people expect. Here's a minor uptrend line too to watch, a very steep uptrend line. So just like we had an uptrend line here, all these little uptrend lines, and you get these divergent highs. This was a divergent high. It's not marked, but we had a divergent high there, divergent high here. These were the corrections, and it's really just an extension of those same divergent highs. We just continue to diverge here. And so my point is, we don't have a divergent high technically because we're a little below that previous high, but just another couple percentage points there, or even equal that previous high, and you're going to have a divergent high. I mean, effectively, we're almost there. You can call it an equal high right now. And so to me, again, maybe there's something more in store. Maybe the divergences get burned through, but as of now, I still see minimal upside before a reversal. And again, divergences can continue to build, and so what you want to watch, what I'm watching, is a break of not just one, but all these trend lines on these sectors I'm showing you, as well as the markets, and most importantly, the tech sector there that we just covered. A couple more here. XLC, communication sector. And that one has about a 10.5% weighting in the S&P 500, and there's a little minor uptrend line that it's above now. So there's the thing. That's why we're not going down much, and we're kind of drifting up. Really, challenging. A lot of sectors are challenging their previous highs. Most are off all-time highs. XLC, we don't have a lot of history. See, we don't have, whereas a lot of things peaked back in January of 2018. Some sectors like energy, well before that. Energy is just in a bear market rally now. I've covered that before. Just to loop back around to XLE, make no mistake about it, and I've said this before, bear market rallies are awesome to trade. They're powerful, they're strong, but when you look at the energy sector, XLE, this is it. Early 2014, that's when energy peaked, and it is still so far off those highs. It'd be hard for anybody to argue that energy is not in a bear market. Even after today's big rally, it is still 37% below where it was back in early 2014. So again, this is just a bear market rally action, bear market action here in the energy stocks. All right, and that's only one sector. It's not the whole market, and the reason why the S&P is close to highs is because this energy is not nearly what it used to be. Years back, I remember it made a much higher weighting. ExxonMobil was the world's largest company not so long ago. At least in my head, it was 10 years ago or so. And then of course all these big tech behemoths, Apple, Microsoft, they all leapfrogged it. All right, we're almost done here. XLP, Staples, rising wedge right there. Divergence that's been building a long time. This divergence shows very clear on the weekly chart. We've just been diverging, building up. It's not as if the divergences haven't played out. Each one's played out for little corrections along the way while you just continue to build and extend those divergences. And we recently had a sell signal in the Staples. And this is about a 7.5% weighting in the S&P. And this one's also failed to break out to new highs. Remember, this was our previous high right here, all-time high. We failed, tested, couldn't get through. Finally, we had a breakout. Hooray, right? Nope, failed. Today it failed pretty impulsively, down about 1%. So you'll watch this. Technically now this becomes resistance about 60-90 or so. And based on this pattern, the divergences, the break of the trend line and all that, this one should head lower. And if so, that's not going to be good for the overall market because that represents about 7.5% of it. And then finally, two more. XLY, discretionary. Here's one that hasn't yet broken. So again, that's a common theme. Some of these sectors seem to be rolling over, but others are still holding above trend. And you can see right here, we just put in a divergent high. We certainly have room to extend that divergence like this. Pop up, we'll continue to walk up this trend line, or we could break down any day now. And that's what you want to watch. So whether we do this or we do this, to me, it's a matter of that, and you're only talking just like the broad market, a few percentage points. Much more than that, then I'm just wrong. And then that's the next couple levels there, some support levels to watch. But again, no sell signal yet on XLY, but it was down today quite a bit, about 1.28%. And then finally, XLB, basic materials. They're not going to move the needle too much because it's only it's less than a 3%. Weighting, but it's the same story, and that's why I wanted to go through all these. I know I might bore you going through 11 different sectors in addition to the index charts, but this is the market. I always say the stock market is simply a sum of its parts. Now, we're not going to go over all 500 stocks in the S&P. Even if we did, that's not the entire stock market. Those are only large cap stocks. There's still mid caps, small caps, and other ones out there. So, but if you want to get a good idea, most people consider the S&P the broad market. It's most diversified of the indexes, representative of, like I just said, 11 different sectors. And the common theme is that just about all of them, I mean, if they haven't broken down yet, they are either at or very close to their previous highs, and all of them have these negative divergences, which again, without fail, going back for quite some time now, you get these divergent highs, correction. Well, that correction from there to there didn't end till we were right here. Last time we had a divergent high right here, and that was just a PPO divergence. You still had a pretty nice correction. And it works in reverse. You get divergent lows, and those are your rallies there. So that's it. So there's a pretty big reversal on basic materials today, pretty big red candle. And so whether it wants to say this was a double top high and there's your divergence, we could certainly say that. Only time will tell. I don't expect us to really have a definitive answer until the Fed's out of the way. And you might want to put a minor trend line there to watch as well. So, like I said, minimal upside is what it appears to me on this chart, unless things change, unless we start to power on up, blast on through. There's a lot of overhead resistance. That's the other story. For those indexes that are not near new highs, which the majority aren't, you have a lot of big overhead resistance to contend with if you happen to move up above those previous reaction highs. In addition, you'll be challenging those previous highs with divergences if it happens anytime soon. So that's why I'm very open to a post FOMC pop, at which point I would probably be selling or shorting into. If I happen to have any longs that day, I'll probably unload those longs as well. All right, let's wrap it up here. To be continued. And again, maybe something big happens tomorrow, maybe something big happens Wednesday before the Fed, but chances are no. Chances are just kind of grind around, and then the market will pick a direction by the end of the week. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.